Okay, welcome back to Infinite Investors. Listen, in today's video, I'm going to be talking about coping with a crash. I am very mindful of the fact that a lot of you guys that follow this channel are new investors, have started your investment journey very recently, and all of the stuff that's been going on with the coronavirus situation is going to be a very big shock to the system. Some of you guys would have invested money, seen your profits rise 10, 20%, etc., thinking that everything is rosy daisy, you're doing the best, everything is great, and then all of a sudden not only have you lost all of your profits, but potentially you're eating into your own principal and capital. And now you're wondering, what should I do? Should I be selling? Should I be buying? Should I be holding? You know, what is the best thing that I can potentially do in this current situation? So in this video, I'm going to talk about how to cope with the crash. I'm going to talk about some of the pros and cons of selling, of buying, and of holding. I'm also going to talk about 5 factors that I think is really important to think about and to be considering whilst you're in a position like the position we're in at the moment, and also give you some stories of some people that actually benefited from the last recession, because it's always good to look back, see some examples of how things have gone for people, and maybe that can provide some insight in terms of what you may or may not want to do. So if you want to hear all of that plus more, please like, comment, subscribe, help the channel get to 4K subscribers so we can get the world of investing out to more people in a clear, simple and transparent manner. But first, I'm going to start with some positive news. Freetrade have announced that they now are making instant orders free forever. Instant orders will be free forever. For those of you that knew or don't know or whatever, instant orders are always £1. Basic orders executed at originally 4 p.m. and then it moved to 3 p.m. Was obviously free. And one issue that I always found with basic orders is that I would say queue up maybe 10, 15 basic orders and then come to the app maybe a couple of hours later and find that maybe 2 or 3 of them have been rejected, and I'd have to wait until the next day in order to basically do that. Now, if I've got an investment that I want to make, I can obviously just do an instant order and it'll be free immediately. Now, I've had a very good question in my DMs from Ralph. Shout out to Ralph, and he's talked about how does this impact from a business model and a financial perspective. And I think that's a really important point for those of you that have invested into Freetrade from a crowdfunded standpoint and obviously want to see Freetrade grow, and hopefully you get a return on your investment at some point later in the future. Now, for me personally, I think Freetrade is still extremely early in the journey. I remember going to one of their Freetrade open days. I can't remember what they called it. It was like an open evening or whatever, and they mentioned that up until that point, I think they only made about 20k from instant orders. Now, I think their subscriber base has probably grown maybe 5-fold from that point, but still I don't believe that instant orders has generated them, you know, millions and millions in profit. So at the end of the day, they're still a startup, and you know, they have alluded to the fact that there's going to be, you know, premium accounts which, you know, will be too irresistible to not pay for, and there's going to be other things that they're going to do. You know, when junior ISAs come about, when SIPs come about, you know, when there's going to be, you know, a whole bunch of new features that they might actually start charging for. If you have invested into Freetrade and you want to see them be successful and you want to see them earn money, then, you know, that's definitely going to happen. So my perspective, I think this is a good thing. I think this is going to open the barrier for a lot more people to start investing. It is truly commission free, whether it's basic or whether it's obviously instant. They probably should just get rid of the whole basic order situation, because there's really no point to it. You might as well just let people execute orders up until market close, really. But yeah, I'll let them, you know, handle their business and do what they're doing. But my personal opinion, this is a great thing, and obviously I think it's going to encourage a lot more people to do a lot more investing. But let's get into the crux of this video. Right now you can see I'm on Simply Wall Street, and this is my portfolio. You guys have seen this picture before. This figure here was about 15, 16, 17% before. It's now sitting at 4%. I was at about 5k profit maybe a week and a half ago, maybe 2 weeks ago. I'm now sitting at about 1300, and when I actually look at my free trade, this updates once every evening. So when I look at my free trade portfolio, I'm actually about £700 in profit or something along those lines. So basically, I've lost like 4,300, or I'm down 4,300 from a capital gain standpoint. Obviously dividends is the same, that doesn't change because that's obviously just earned income. But yeah, overall I'm down quite a significant amount. 4,500 is a lot of money to be down. Maybe not to some people if they've got a lot of money, but to me it's a lot of money to be down. However, the way I see it for me personally is that I do, and I am, and I will continue to look at this as an opportunity. When I'm looking at my stocks and I'm seeing who's been the most affected over the last 7 days, I'm seeing Uber's 20% down, AMD always making dough, well not at the moment, 17.4% down, Shopify 15.81% down, but I'm still pretty much in the green with Shopify quite a bit actually. Virgin Moolah down, Legal and General, Pineapple, First Solar, Micro Hard, Lloyds. Listen, I'm down across the board. I'm down in double digits for one, over 13 of my stocks, and I only hold like 20, and then the rest of them, maybe 14 actually, and then the rest of them I'm down 9%, 8, 7, and the only ones that I'm not down as much is obviously the bond that I hold, which is the monthly dividend payer. Obviously you can expect bonds as a hedge in play for them to not really do that badly in this climate, and then sentiment as well, which I'm down now 5.41% this week, and I'm going to give you a reason why gold is also down. Typically you'd find that gold would be going up when stocks are going down, but actually gold is going down as well as stocks. That's a very, very interesting reason why that is, so I'm going to be talking about that a little bit later on in this video and why that's happening. But yeah, I'm seeing discounts. All I'm basically seeing is that a lot of things are on sale at the moment, and so in the video I'm going to talk about people that are buying, people that are selling, people that are holding, and the different mentalities and attitudes and some of the pros and cons. And I'm going to be talking about what I'm personally planning to do, but just to give you a little bit of an insight into that, I'm seeing a lot of opportunity. I'm seeing a lot of stocks that I really struggled to invest in before because they were at too high valuations, and now they're giving me opportunities to actually buy them. And there is a quote that I'm going to talk about later on this, but if you think a stock is good to buy at $200 a share, then obviously it should be great to buy at $150 a share. So if you actually are focusing on the business and on the stock, and you are willing to buy it at $200 a share, you are willing to buy it again at $210 a share, you was willing to buy it again at $230 a share, then you should definitely be willing to buy it when it drops down to $150 a share. Remember to be focusing on the business. So right now I'm on the Guardian, and it talks about the FTSE 100, and it says the FTSE 100 loses more than 200 billion in the worst week since 2008. You know what 2008 was, right? That was obviously the last global financial crisis. It says the FTSE 100 has plunged by 11% this week. Wall Street is tumbling again. Someone tries to calm the markets. Markets lose 5 trillion in the worst week since 2008. Recession fears stalk markets. Dow suffered record points fall last night. Listen, the market everywhere is down. The market is absolutely down everywhere. And obviously I will leave this link in the description, but there's just a few things that I want to point out, in this, that we'll basically talk about. So in the FTSE 350 biggest losers this week, it talks about some of the losers. You're seeing stock losing 30% of its value. Like, remember, if it loses 100% of its value, it's effectively bankrupt. So 30%, try and understand, it's a very, very, very significant number. Sometimes, stocks lose 2, 3, 4% and people are crying. 30% is an astronomical number. And one thing I have noticed, obviously, it being TUI, it being EasyJet, you're seeing that it being international consolidated airlines, because obviously they're travel related businesses. That one thing that I personally believe is that with the situation with the coronavirus, the travel stocks are the ones to probably stay away from, because those are the ones are going to really take the biggest hit, because people are going to be scared to travel, people are going to be cancelling and stop traveling, and then you're going to have countries that are actually blocking people and saying that, you can't actually travel anymore, just like Italy's doing, etc. There was the first case of a Briton basically passing away from coronavirus this today. which I think is significant, and I think is obviously very sad. So my condolences to them and their family. But obviously, from a stock market and financial perspective, that's only going to increase the panic that's going on in the market, particularly with Europe. You've got the European markets have tumbled a further 12%, and you can see all of the graphs here are down, and that's obviously very, very significant. Germany, particularly being the biggest economy, within Europe, you're seeing that that's down 12.4% this week, and obviously the FTSE 100 was down 11% this week. So the biggest economy in Europe is down, higher than us at the moment, us being the UK, obviously. So you're seeing, a lot of that is very, very significant. Obviously, this is just a FTSE 100 chart, and it's just basically showing the direction that's basically been going in as well. 206 billion wipes of the FTSE 100 this week, obviously triggering from coronavirus, as we obviously know. Now, the key with gold, one thing that's really, really interesting as well, is that typically stocks down, commodities up. That's typically the way things go. Not in 100% of scenarios, but I would definitely say in 85 to 90% of scenarios. The reason why gold, silver, platinum, palladium, they're all down, including currencies as well, is because people are actually selling their gold positions in order to cover their losses. So the way I interpret that is people feel that their stock market losses are so severe that rather than hedging in gold or another commodity, they're actually selling off those positions with whatever profit they might have made with that in order to try and cover some of the losses that they made in other areas, which for me is a significant behavioral characteristic, shall I say, which is actually, I think, quite unique and quite new. So we're seeing that gold is also falling sharply. So don't just think it's that easy to jump into a gold stock or jump into a gold miner stock and everything's going to be rosy daisy. It doesn't really look like that's going to be, the case. The pound is also falling as well. So you're seeing that the pound is falling as well as stocks. We all know that there is typically an inverse between currencies and equities, and usually the pound goes in the opposite direction, but you're seeing that both is falling. So you're seeing a lot of factors that really basically indicate that, it's very, very trying times, and we don't know how long this situation is potentially going to last for. So with that being said, the question that I start to ask myself is, what now? What now? I'm not a type of person that just wants to read negative headlines and then basically just go to sleep like that. I want to try and understand, okay, this is what's happening, but what kind of opportunities are there potentially for me as an investor, if any, because, there could be situations where there isn't actually any opportunity, and what sort of things to look at. Now, I personally have decided to look at the 2008 recession, and I wanted to find out, how did people make money during that recession? What did people do? What strategies did they take on? And is there anything that I can potentially learn from that? So I'm on this Reuters article, and it says the world's rich got richer amid the '09 recession report. The rich grew richer last year, even as the world endured the worst recession in decades. A stock market rebound helped the world's ranks of millionaires climb 17% to 10 million, while their collective wealth surged 19% to 39 trillion, nearly recouping losses from the financial crisis, according to the latest Merrill Lynch Capgemini World Wealth Report. Stock values rose by half, while hedge funds recovered most of their 2008 losses in a year marked by government stimulus spending and central bank easing. We are already seeing distinct signs of recovery, and in some areas a complete return to 2007 levels, obviously prior to the recession, levels of wealth and growth. Bank of America Corp Wealth Management Chief Sally Krawcheck said the fastest growth in wealth took place in India, China and Brazil, some of the hardest hit markets in 2008. Wealth in Latin America and the Asia Pacific soared to record highs. Asia's millionaire rank rose to 3 million, matching Europe for the first time, paced by a 4.5% economic expansion. Asian millionaires' combined wealth surged 31% to 9.7 trillion, surpassing Europe's 9.5 trillion. And then it goes on to talk a little bit more about that. Millionaires poured of their money into fixed income investments, seeking predictable cash returns and cash flow, etc. And then it talks a little bit more about that. I'll leave the link in the description. But one thing that basically struck to me in this one is obviously the fact that some of the world's hardest hit markets, India, China, Brazil, some of the emerging economies actually basically really did well. So I'm not here basically preaching about emerging economies, but the thing I'm basically taking from that is some of the things that actually get struck the hardest, some of the things that actually get beaten the most, tend to actually then maybe have the best bounce backs. So when I'm looking at some of my stocks here, and I'm looking at our Uber's 20% down, AMD is 17.4% down, I'm basically relating that to start to think, actually, you know what, these are the stocks that might, for me, potentially have the best bounce back and the best basic return. I'm on CNBC. Number of billionaires double since financial crisis. The super rich club has become less exclusive, with the amount of billionaires doubling since the financial crisis, according to a report from global charity Oxfam. There were 1,645 billionaires globally. I'm talking a million numbers now. I'm trying to talk them big numbers. Listen, 1,645 billionaires globally as of March 2014, according to Forbes. Blah, blah, blah. Oxfam honed in on this figure, highlighting the growing gap between the world's rich and poor. Hundreds of millions of people live in abject poverty without healthcare or education, while the super rich continue to amass levels of wealth that they may never be able to spend. And it goes on to more. It's a very interesting article, so definitely go and have a read of it. Link will be in the description. Again, for me, the thing that I'm basically taking from this is the gap between the rich and the poor, and it's trying to understand what are the rich doing that is different to what the poor or the masses do, that I can basically learn from in order to take advantage of this situation. So I'm on this other article from CNBC, and it talks about 5 different stories of 5 regular average individuals, just like yourself, you and I, or maybe you guys aren't average. I don't know who's listening to this, but I'm average. I'm Av. So I'm basically seeing some stories about how certain people took advantage of the last financial crisis and what they basically done. So in this scenario, you've got Carrie Piakowski, 40, who treated the last recession as an opportunity to go on a buying spree. Every penny she had went right into stocks. At the time, she was working for ING Direct, now Capital One 360, in customer service. It wasn't the easiest time to work for a brokerage, taking orders, she says, but she told people, and this is the quote I mentioned earlier, which I think is phenomenal: if you liked SPY, which is the S&P 500, at $103, you should love it at $83. Now, when I go back to my portfolio, if I liked Uber when Uber was at $45 or $46, then there is no reason why I should not be liking Uber when it's at $32. If I now I'm just going to go sell all my Uber shares, then I didn't really like Uber, or was I really invested based on the fundamentals? Why did I actually buy it? Was I following a trend? Was it just based off momentum? These are the sort of questions you guys need to be asking yourself. I try not to give people answers, but just to give you more questions, and you guys can figure out the answers for yourself. At the end of the day, if you believe in the business, then me buying Uber at this price, which I was doing, I should still be able to buy Uber at this price. In fact, I should love Uber more at this price. And this doesn't just go for Uber, this goes for any stock that I particularly hold. If I like the stock at a high price, let's take AMD as an example, then I should obviously like the stock at a lower price. I'm seeing drops everywhere, and really and truly, if I do believe in the company, if I do believe in what they're doing, their products, their services, if I do believe in their growth potential, and I am thinking long term, then actually I shouldn't really mind that it's going down in however much it goes down, because I'm believing it long term. Anyway, you should love it at $83. Piakowski, an IT manager in Exton, Pennsylvania, says she's fortunate she learned so much about finance while working for ING. She was under 30, and when the recession hit, she says she took it as an opportunity to buy stocks at fire sale prices. Not so secret stores. People that aim to be financially independent and possibly retire early have one thing in common: they invest. This whole channel is about investments. At the end of the day, some people have been talking to me in the DMs about trading. Some people have been talking about shorting. Some people have been talking about other tactics to try and get money, etc. And you can do all of that. I trade. I do all of that as well. But ultimately, this channel is about investing. And if you are into the stock market, if you are investing, then you're doing it for the long term. And so if you are doing it for 5, 10, 15, 20, 30 year periods, and that's the time frame that you're thinking about, this little 3, 4, 5 month dip, however long this coronavirus dip, it will come to an end. It won't be a whole year dip. It will be a dip for a few months. It should be minor, and it should really be an opportunity. The way I see it is an opportunity, but you should potentially see it as an opportunity too. They invest. Not only do they invest, they do it aggressively and they do it often. This should be something that you should be consistently doing, consistently hammering money into at this current point, based off this at the moment, where obviously the opportunities are being presented. Grant Sabatier, for example, who went from broke to millionaire in under 6 years, checked his progress daily. I'm a person that I check my progress multiple times a day. When I'm up or when I'm down, I like to go into the Freetrade application. I like to see what's going on, and I like to start to think about what I'm basically going to do. If he had an extra $60, it went straight into one of his accounts. Listen, Freetrade instant orders are free, guys. This is a commission-free broker. You are not in the days whereby when you wanted to make a trade before, it used to cost you £12.50 for a trade, and now you would have to then make so much in order just to break even. In this context, if you've got a spare £3, a spare 50p, a spare 70p, a spare 92 pounds and 4 shillings, put it in there, put them shillings in there and make that money. At the end of the day, if I've got spare cash, I'm always dumping all of that into Freetrade. I personally have done so aggressively over the last year that, as you guys know, I've only got £1,000 left on my ISA allowance, which I'm going to be doing next week, and I physically cannot add any more money into there until April the 6th because I've done my maximum. But if you're nowhere near your ISA allowance and you do have spare change, then listen, if you've got £1, if you've got £10, if you've got £20, in my mind, what I personally would be doing is dumping every single last penny and trying to accrue as many shares as possible. It went straight into one of his accounts. Sabatier and people like him invest a high percentage of their income. Even those who aren't highly compensated tech people shovel in as much as possible. I'm a shoveler, but you can call me a shoveler, man. I won't be offended. I shovel my money as much as possible into my stocks. I do invest aggressively, and I don't put a high percentage of my income, I would say, but I definitely put a decent percentage of my income into stocks and into savings. Just because, I want to make as much money as I possibly can in the long term. Like, I don't really want to be thinking, 5 years down the line, I wish I invested an extra 100k. If I did have 100k spare, I would rather know that I put that money in there. And like I said in my most previous video, I'm more of a person, me personally, I'm more of a type of person that if I don't do something, I regret it more than doing it and it going wrong. That's just the way I personally am. You guys might be different. So this is all about people that are taking all of their spare change and they're shoveling into the stock market as much as possible in order to basically get that return. A rocky ride. You've got loss is a temporary part of the game. There is a stat, and I really wish I could find the article that basically proved this stat, so it's not just me talking at my hind parts, but basically there is a stat that basically says something along the lines of, in the course of a year, the stock market goes up 2/3 of the year and it goes down 1/3 of the year. So it calculates all of the times it goes up, all of the times it goes down, and basically around 200 and something plus days the stock market goes up, and around 100 and something days the stock market goes down. I'm really sorry that I haven't got the actual link, or the actual thing is something I learned a while back and I haven't actually found the link. There's basically another stat that basically says over the course of 10 years, if you take any 10-year period in the market, so whether it's January 2009 to January 2019, or whether it's May 1973 to May 1983, whatever, any 10-year in the market, apparently in the last 200 years or whatever, you've always had more money at the end of the 10 years than at the beginning. So basically what it's trying to say is that over any 10-year period, every investor, not one, not two, not just the millionaires, not just the random people, every investor would have been up versus down. Every single one. Every single one. That includes you listening. That includes you in Scunthorpe, you in Teesside, you in Birmingham, you in Brighton, you in Brixton. All of you listening to this right now, if you invested over a 10-year period, all of you would be higher at the end of 10 years than you was at the beginning when you invested. So that says to me that loss is definitely a temporary part of the game. This is part and parcel. You can't have sun without having rain. Or maybe in some parts of the world you can, but listen, you have to have the rain and the shine. At the end of the day, all of this rain, all of this down times is an opportunity, and you should really start to see it as an opportunity. This talks about this person basically funneling it all into their 401k, which is basically like an American retirement fund, American pension, I think, or retirement pot, something along those lines. I don't really stay abreast of all of their random stuff, but basically along those lines. And they did exceptionally well from that standpoint as well. And there's another story here which basically says ignore the news cycle and take a 30,000 foot perspective rather than individual days and monetary drops. Now obviously this person talked about seeing their thing daily. I don't think this is contradicting that. What this is basically saying is when you're investing, you're not investing based off the intraday movements or the intraday jumps and the intraday falls. You're basically having a more strategic, ballooned out macro view, and you're looking at it more broadly and saying, okay, so let me look at the landscape over 5 years. What's happening over these last couple of months? Is this an opportunity for me? An example of that right now, this is the S&P 500 since 1980, right? So you can see the S&P 500 since 1980. You can see that there is a period here where from 2000 down to 2003 it just consistently fell. That's 3 years of falling. We're having conversations about falling for the last 2 weeks, and people are crying, scrambling for the hills, climbing behind their sofas, doing a whole bunch of madness. This is 3 years. Imagine 3 years of consistently going down. That's a significant period of time. And then when it did rise back to its original levels in 2000, and it did that 7 years later, it still was just basically the same levels, roughly 1506 here, 1552, like roughly the same levels. It took 7 years to get back. Then when it just only got back to the same levels, it dropped again. And you saw that over a year period, it lost nearly half its value, probably about 45% of its value. And then again, it took about, we're talking 4 years this time, in order to get back to the same levels that it got to in 2007 and in 1999. So you're thinking, if you was investing around this period and you got up here, you're thinking actually from 2007 all the way to 2013, it really actually didn't have that much of an impact for me. Like maybe if I claimed some profits and maybe if I bought more at lower prices, blah, blah, blah. But overall, it really didn't have it. And then look what's happened since then. From 2000 and, from this recession, effectively, it just basically rocketed. And if you stayed in the market, if you kept on buying at these lower prices and just kept on aggressively funding your portfolio at these periods here and kept on aggressively funding your portfolio at these periods here, then you'll be laughing at these periods here. And look, there'll be another drop, but I guarantee that drop won't go down to these levels. That drop will be probably around here maybe. That could be like a couple of years of dropping. And what I'm basically taking from this is that when it talks about looking at a 30,000 foot perspective rather than individual days of monetary drops, I'm looking at historic graphs and I'm going, you know what, actually let me train my mind to expect a fall for the next 2 years. Okay, so if I know that now all of my stocks are going to fall for 2 years solid, what am I going to do? Am I going to sell up now and then just wait 2 years and buy it? Well, no, because it might not fall for 2 years solid. It might fall for 18 months or 1 year. And then by the time I start to invest, it might be at the same levels again. Who knows? I'm going to just continue to hold my stock, and I'm just going to continue to invest aggressively as I possibly can, whilst I still have the potential to earn, whilst I still have my earning potential, whilst I still save a little bit of cash for rainy days and for other things that I want to do in life. Whatever I have left, I'm going to put into the market, because I know that hopefully, in the long run, it will pay dividends for me, no pun intended, and I will obviously, get a much better return. So basically, I wanted to talk to you about this. Listen, there are 3 types of people right now. You're going to have the sellers, the buyers, the holders. The sellers, the buyers, the holders. The sellers, the buyers, the holders. And ultimately, there are pros and cons to doing all of these different types of activities. Now, if you are a person that's thinking, you know what, right now the stock markets are going down quite considerably, I'm actually going to sell. Is this a good or is this a bad thing? I'm going to give you some pros and cons to everything, because I don't think everything is actually as clear cut as it might seem, and I don't think everything is just either a pro or either a con. I think it's all relative to your situation, and whilst I can't obviously speak to all of you guys individually and know your situations, I'm just going to give my broad blanket view. If you are thinking to sell, there are some pros to that. One of the pros is covering your profits. If you've got stocks that are in profit and you're thinking, you know what, I'm going to take this as an opportunity to sell and claim some of the profits, I don't think there's anything wrong with that. I don't think there's anything wrong with taking some of your profits from some of your stocks and sitting it out and actually deciding to reward yourself, and actually just then deciding to wait and see what goes on. Another good potential justification for selling right now is that, you know what, you can actually start to diversify a bit more. Maybe you've actually overextended yourself in one industry, one sector, one stock, and you can start to look at it and be like, you know what I'm going to do now is actually put that money into another stock, into another sector, into another industry, into, you know, another asset class perhaps, and actually diversify and reallocate some of my portfolio. So for me, there are some pros to selling. I personally, I'm not looking to sell anything that I currently hold. Once money goes into my free trade, it don't come out, it don't come out. Once it goes in, it does not come out. So I personally, I'm not going to be doing that, but I don't think there's anything wrong with any of you guys thinking about doing that. However, what I will say, some of the cons of selling is if you are selling based off panic. If you are panicking and you are selling and you are taking losses now, and then you're just thinking, you know what, I'm scared and I'm just going to sell, I don't think that's a good thing. I don't think that's a good behavior. I think you should remember why you invested into the first place, and hopefully that should encourage you to sit something out, at least a hold, but definitely not to be panic selling as well. And listen, it goes back to the whole point. 2/3 of the year the market is going up, only 1/3 is going down. So you know what, I think that most things, providing they're decent stocks and not stocks in distress or anything like that, or really cheap, scary penny stocks that people are doing as a punt, if they're just normal, genuine, good businesses that are being significantly hit unfairly by this coronavirus situation, then we know that 2/3 of the year they're most likely going to be going up, whereas 1/3 of the year they might most likely going to be going down on average. And really and truly, I wouldn't be selling if that once, now that I know that statistic, I wouldn't really be selling. Then you've got people that are buyers. There are positives to buyers. I'm a buyer. I would say I'm definitely a buyer. I'm a shopaholic. Yeah, I like to shop in the market. I like to shop. I don't really like to shop elsewhere. Actually, I don't mind shopping elsewhere, but you know what, from a market standpoint, I'm a shopper's bee. I like to shop. And you know what, you can find a lot of dips within your current portfolio, and there's great opportunities for you to dip. You guys should be seeing this as a sale right now. You should be seeing this as the next Blue Cross sale. You know, everything must go. This should be one of them. You know, they know DFS, like DFS just always on sale, like they have definitely broken every advertising standard law in the UK, because they are always on sale, and you can't be always on sale, because effectively that means your prices were never actually the prices you quote them at. But anyway, that's a whole nother topic. Listen, DFS is always on sale. Right now the stock market's on sale, and this should probably be the time to buy. You know, you will get more dividends. You know, if you think about the fact that if you are basically investing into dividend stocks, and obviously shares are going down, share price is going down, then effectively for the same amount of money you can get a lot more shares. And obviously dividend is on a dividend per share basis, so effectively you get a lot more dividends as well. Dividend yields are increasing, so you're getting that 8%, 9% yields, and you're getting a better return from a dividend standpoint on your money as well. Also, now there are opportunities that before you potentially couldn't invest in. Listen, I wanted to get into Tesla, but at $300 I felt Tesla was too expensive, and I remember in my videos I was like, I'm not buying Tesla at $300. I'm going to wait till it hits 200. And what does it do the next day? It goes to 500. I'm definitely not buying at 500. I'm going to wait till it goes to 350. Next day it goes to 700. All right, cool. I'm not getting at 700. If it goes to 450, I might buy it. Next day it goes to 900. Listen, now for me, if the stocks keep on dropping like this, it now opens up a whole plethora of opportunities that weren't otherwise available for me personally. Stocks like Tesla, which for me now become more palatable, shall we say. Shout out to someone in my DMs used the word palatable. I loved it. That is now more of a palatable investment for me, and it's something that I potentially can get into. So if you're a buyer, you know what, there is opportunities there. However, for those of you that are buying, there are some cons, and it's worthwhile being cautious of it. The first con is yourself, greed. Don't be too greedy. At the end of the day, there's a lot of rules that I always quote on this channel. The rules of having your own emergency fund, which is 3 to 6 months of expenses, because you never know what could happen. If this triggers a recession, this might trigger job losses. You may unfortunately be affected by that. You need to be able to cover your expenses until you find a new job. So greed is a significant thing, and I don't want anyone being greedy. I was talking to Dean in the comments recently. He even talked to me about, this guy was telling me about, should he take out a 10k loan to basically go and buy more stocks? That's greed right there, Dean. That's greed. We already had a very strong word about that previously, and I'm just giving you a reminder. I don't want anyone doing anything crazy like that, because again, that's just greed. And that could really, it could go sour. It could go sour, and that could really turn you the wrong way if you don't turn out the wrong way if you don't obviously look after your money in the right way. The second thing is that prices can still fall, and so we don't know how long this has been. I think this corona stuff has basically triggered my portfolio for the last 2 weeks, because even though we known about coronavirus beforehand, 2 weeks ago I had 5k profit. I was fine. So for me personally, if now I've only got £700 profit or whatever, and I've gone down 4,300 in the last 2 weeks, but we knew about coronavirus for the last 3-4 years, I don't know, a month, let's say a month or whatever, it can still go down. When we look at how long SARS lasted for before there was a definite cure, etc., that was about 4 or 5 months. If we look at recessions, we're talking things are happening for years and so forth. So, the market could still go down, and it could be premature to just buy everything now. If you're thinking, I've got 3k sitting in my savings account, let me just put all of that 3k into the market, but that's the only cash you've got spare, that's a bit greedy, and the market could still fall. And obviously there is a concern with that. But if you are still sticking with your strategy and you're thinking, this is a good time to buy, and rather than putting £500 a month away like I was doing, I'm going to push myself now. I'm going to be like the person in the stories we saw on CNBC, and I'm going to add anything spare I've got, and maybe I'm going to stretch it to £750 a month, but I'm still going to do my other commitments and save my cash and do all the other things. Then actually this is a definite good time to do that. Then you've got the calm people, the people that are just chilling. They're the holders. They're people that are just nonchalant. They're just chilling. They're meditating. They're kumbayaing. They're just thinking, you know what, I'm just going to relax during this period, and I'm just going to see what happens. I don't think there's anything wrong to that. I think the positives of that is that we don't know how long this is going to last for. And so you don't want to jump into things, willy-nilly. Either erratically sell or start greedily, but greedily, is that even a word? Yeah, greedily buying. And ultimately, holding could be a good thing. But I do think that there is negative to just holding. Don't be blind to the fact that the market is continuously moving. Make sure you are staying abreast of what's going on in the market, and obviously from that standpoint, you will then be able to take care and take advantage of some of those opportunities. And listen, me personally, the last thing I wanted to talk about is just handling losses, and how I'm personally, what I personally feel are the 5 best ways to handle, losses that you're experiencing in the market. I'm not talking about emotionally handle these losses. I'm not talking about therapy or anything like that. I'm just talking about different tactics that you can basically consider in order to manage yourself through the situation. And the first thing, the most important thing for me always, is the fundamentals. Go back over your current investments and just look at the fundamentals. And you know what? If you are happy at $120, then you should be happy at $83. Quite simple. If you're happy with their cash flow, if you're happy with their earnings, if you're happy with their revenue, if you're happy with their customer growth numbers, their sales numbers, their distribution numbers, their production numbers, if you're happy with their cash flow, if you're happy with their dividends, if you're happy with all of the ratios in terms of PEG, price of sales, PE ratios, etc., if you're happy with the fundamentals of that company that had you investing only 3-4 weeks ago and seeing a 1-2% uplift before it all started to go down, then obviously you should still be happy now. So make sure you're looking at the fundamentals of your companies. If you are seeing some things that are a little bit scary, maybe too much debt, maybe you think it's overvalued, maybe you feel like actually some of their guidance or their things in the future is actually not going to be as good, then by all means, then you might need to sell, you might need to do something different. But ultimately, look at the fundamentals of the company, and that should definitely give you some reassurance that you're invested into long-term businesses that hopefully, will be doing well over a long period. Second thing is cash. I can't stress how important I personally believe cash is. Cash is 2 things. It gives you the opportunity to invest when things are down so that you can take advantage of some of those opportunities. But also I think it gives you peace of mind. When all of your money is in the market, you've got no cash, That for me is not peace of mind. And knowing that you have cash available for whatever life may throw at you is going to be, give you peace of mind. But I'm going to take the first example. Let's just put the peace of mind thing to the side right now. I see cash as the greatest opportunity to basically increase your wealth. So if you have cash sitting on the sidelines, it allows you to take advantage of some of these opportunities. I could potentially see Uber go down to 50% for me. Now, what I want to make sure is that I have 1, 2, 3 grand, etc. available that I can be like, you know what, I'm going to buy Uber. I'm going to go a bit hard on Uber at this period, at this period, and basically, allow myself to hopefully do well by the end of the year, by 2021, etc., etc. Gold and bonds. Listen, a lot of people are hedging, and I think hedging is definitely a way to reduce your losses. I just showed you the example of gold where people are selling gold, but I don't think that's going to continue forever. There will be a period where gold will probably start to rise again, where cash is obviously going to rise, where obviously bonds will start to rise, especially if we do go into a recession. So if you want to play it safe and get some ETFs and get some gold and bonds, etc., then obviously that could be another way that you can, handle your losses and minimize your losses. We talked about people are selling, and some people are selling in order to reallocate and to diversify their portfolio. This might be one of the ways that you can obviously do that. Dividend stocks for me as well is a real big opportunity and a real big way to handle losses. Some people talked to me in the DMs and was like, you know what, I'm thinking to sell some of my growth stocks and actually put that money into dividend stocks because I'm going to be getting quarterly dividends. And obviously now you're going to be getting more dividends because you're going to be buying hopefully at the same amount of stocks or the same amount in terms of the amount of capital that you're deploying. But obviously you'll be getting a lot more shares in the companies and therefore a bigger dividend yield and a bigger dividend return. Dividend stocks is going to help you significantly throughout this period. And obviously if you get those dividends and you reinvest that's money that you're reinvesting into the market at lower prices that you didn't have to generate and earn yourself, which I for one think is a fantastic opportunity as well. And the last but not least is dollar cost averaging. That was my strategy throughout the course of last year, which for me I don't think it was the best strategy that I took on for all of my stocks. The reason being is a lot of my stocks were just continuously rising. So effectively, I'm buying at higher prices. If I'm dollar cost averaging a stock at £100 and the stock just keeps on rising in value, then obviously I'm getting less shares, and ultimately I'm not making that much of a return. Where dollar cost averaging now is worth its weight in gold, is now the stocks are falling. So if I'm putting £100 into the market, I'm getting more shares for the £100 than I was previously. And I can just continuously add any spare change that I've got. And like we said, Freetrade is not even going to charge you for instant trades, etc. And this is a really, really good time to take advantage of these opportunities. And so, dollar cost averaging and putting any spare change that you've got into stocks, for me personally, is a great opportunity. Listen, guys, I know we've been talking for about, I've been talking for about 41 minutes, but I know you've been listening for about 41 minutes. So obviously I appreciate your time. And I think, it's an important video for me. I think coping with a crash is extremely important. We can all love the times when Tesla's surging 300% or whatever it's doing, when AMD's skyrocketing, when Okta's going 150%, when you've got some of these stocks like ITM Power and Ceres is 500% in the last year. Listen, it's all good and well when things are going up, but obviously you're going to have times when the market's going down, and as new investors, you're going to need to understand how to cope with a market crash, how to cope when things are going down. And I hope this video has provided some sound tidbits, I love that word, tidbits, sound tidbits and little bits of information that's going to help you, really manage your way through this coronavirus situation. And if it does eventually trigger a recession, then obviously the recession as well, so that you can actually think that, see this as an opportunity, think long term, take a 30,000 foot view, start to basically aggressively put all of the money that you can do into it, but obviously still being cautious and having your cash in reserves. And hopefully then in 5 years, in 6 years, you can go from broke to millionaire, just like the guy did at CNBC, or in the long term, you can potentially retire early. And that's the type of things that you guys should hopefully be thinking about. Listen, I hope you found this video useful. If you did, get in the comments, leave a like, please subscribe if you got this far and you're not subscribed to the channel. And I will catch you tomorrow with a portfolio update where basically all I'm going to do is just bitch, cry and moan about the fact that I'm down, 4,300. However, in light of the stuff we've talked about today, I am actually very, very positive, and I'm seeing this as a very, very big opportunity to, invest more once obviously it hits April the 6th, just because I can't do it that much right now. Invest more, and obviously, hopefully, in the long term, be laughing. So yeah, hopefully you found this video useful. Get in the comments, like, comment, subscribe, and I will catch you tomorrow with another investment video.